Low implied volatility can make a long vol position look cheap, but if realized volatility stays quiet, theta can still grind you down before the market ever moves. That is why cheap volatility is not the same thing as a timing signal. This is one of the hardest lessons in options trading. When 4 percentile is low, the trade can look statistically attractive. But price alone does not tell you when to deploy more capital. A low volatility regime can persist much longer than most traders expect, and if you keep averaging down mechanically, you may just be increasing the speed of the bleed. The mistake is assuming that a cheaper entry automatically improves the trade. In a structurally long premium position, you do not need to be wrong on direction to lose money. You only need time, and a calm market. Time is the hidden cost. The better question is not, is volatility cheap today? The better question is, has anything changed that improves the probability of a profitable long vol outcome? If you have already deployed 50% of your intended budget into a long 30 delta strangle, the first question is whether the original thesis is improving. Not whether the entry is cheaper. That distinction matters. Long volatility is not a value trade in the usual sense. It is a regime trade. You are buying because you believe the market is underpricing future movement relative to what is likely to emerge. So confirmation has to come from behavior, not from price alone. A useful framework is to look for three things. First, realized volatility begins to rise meaningfully after a quiet period. Second, implied volatility stops compressing and starts to stabilize. Third, the volatility surface shifts enough to suggest a regime transition. You can also see it in price action through larger ranges, gaps, or failed mean reversion. If none of that is happening, then the market is not confirming your thesis. It may simply still be calm. And when that is the case, adding more exposure can just make the drawdown worse. This is where risk management matters more than conviction. You can be right about the eventual volatility expansion and still suffer an unacceptable drawdown if you scale too aggressively before the regime changes. Good process means surviving long enough for the thesis to play out. So with half the budget already deployed, the disciplined choice is often to reserve the rest for confirmation. Not to abandon the position, but to treat the remaining capital as optionality on evidence. If realized volatility improves, or implied volatility stabilizes, or the market clearly starts to shift, then you still have dry powder. If not, you have preserved capital instead of forcing a full-size loss into a stagnant regime. That is the key lesson here. Many traders think in terms of entry price. Professionals think in terms of state changes. Cheap volatility can stay cheap. The market does not reward impatience, and theta does not care that your entry looked good. In volatility trading, the goal is not to be right in theory. The goal is to manage uncertainty so that being right can still matter in practice. That is how capital survives long enough to compound.